the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Hey everybody, and welcome back to Teaching Tax Flow, the podcast. Today, episode 73. We are going to step up our game and talk about the step up in basis, what that means if you even care at all about taxes. And we know you do because you're here. Before we get into the topic, though, let's take a brief moment, as always, and thank our sponsor on this episode.
This podcast is sponsored by The Mortgage Shop. Are you looking to qualify for an investment credit loan without jumping through hoops? That's easy. They have loans with LTV up to 89.99%. Exploring their products and discovering how they can work for you is simple. Just visit mortgage.shop or call 865-325-2566 and tell them TTF sent you.
Welcome back to the Teaching Tax Flow podcast. Hopefully you listened to the intro. If not, we know you're anxious. You jump right into it. Today, step up in basis is on the table. And Chris is back with us. Chris Pacquiao, how are you, man?
Oh, it's so good to be back, Johnny T. How are you, my friend?
Ooh, it's Michigan. It's chilly, but it's all good, man. It's all good. Let's warm up the plates and talk about what in the world is step up in basis. And actually, here's a little disclaimer on my end, right? Everybody knows I am not the tax guy. You are the tax guy. I am really not sure 100% what this topic even is. So give us your, well, call it a knowledge nugget, I guess, on what step up in tax basis actually is.
This is a confusing topic for many, even some tax professionals. And it's a topic that causes people sometimes to pay too much in tax. So we're going to keep things as elementary as possible because this is a confusing topic, like I said. So here's the situation. Let's start with basis. Okay, first of all, before we talk about step up in basis. Basis is a term that we use in tax, and it's short for cost basis. So really easy example, John. Let's say that you bought a share of Bitcoin.
Okay.
Or one Bitcoin for $30,000, and you go and sell it for $60,000, okay? Your cost basis for that Bitcoin is $30,000. You sold it for $60,000. So to determine what your capital gain is, so how much you pay tax on, you take the $60,000 minus your cost basis of $30,000. Then obviously, if it's a long-term gain or short-term gain, it's taxed differently. That's the most simplistic tax basis that we can come up with. All right. So a step up in basis is a special rule in the tax code that allows people to adjust their tax basis for any asset that they inherited. So you're going to hear a lot of times people say, well, it's much better to inherit assets than to receive them as a gift. All right, we're going to talk about that, in our example. So everyone take a breath, understand we're going to go through a real life example. Names have been hidden, but to really explain the step up in cost basis. So the bottom line is, when you inherit an asset, now that asset could be that cryptocurrency, it could be a home, it could be a stock, it could be a piece of artwork, any asset. When you inherit that asset, your cost basis, meaning what the IRS is looking at it, what you've paid for that, is whatever the fair market value is at the time someone passed away. And so there's an adjustment. So for someone inheriting an asset from what we call a decedent, usually it could be through just a will, a probate case, or a trust. The tax basis of the asset gets stepped up to fair market value.
So I know on this, if anybody's a fan of those true crime podcasts, and you talk about, hey, you're better to inherit than better to be gifted. We are not implying you should go out and start, whacking your in-laws or anything. So this is not a murder.
No, that's not
It's
advised.
not a murder investor, whatever. You get where I'm going with this. Let's get back on topic. So, yeah, walk us through this. I'm super curious. I'm like super curious on how this works because, right, this is something that I'm going to make the assumption a lot of people don't even know exists, right? And they just kind of assume that things are going to happen. So this, I think, will level the playing field with a lot of concerns, I should say.
Absolutely, because a lot of tax software, even if you're a self-preparer or if you're someone that prepares taxes professionally, even those, a lot of times those softwares don't trigger to figure out if the asset's been stepped up. So there are three real big benefits of a step up in basis. And there's a reason. Remember, one of the three laws of teaching tax flow is that tax laws are written to encourage or discourage certain behavior. So we want to inherit assets. We also know that the IRS wants some type of simplicity. Now, if you're snickering when you hear that, we understand. But let me explain. So there's three main benefits of a step up in basis. The first one is a reduced capital gain, right? So John, let's say you had that share of Bitcoin, you paid $30,000, it's worth $60,000. You get hit by a beer truck. That's how I like to knock people out, right? And your daughter inherits it. Okay, some reason Stacy doesn't inherit it. Let's just go with it. Your daughter inherits it. She sells it the next day for $60,100. Okay, she gets her cost basis is $60,000 because that's what it was worth when you got hit by the beer truck. She only pays tax on $100, thus reduced capital gain. She sells it for $60,100. Even though you paid $30,000, her basis is $60,000. So a reduced capital gain calculation is huge. And this is something that people don't know that about. Any inherited assets are automatically considered long-term capital gains, which we know are the lower rates. So even if you inherit an asset, you don't have to keep it for a year to get the long-term capital gain treatment. So one is reduced capital gain. Number two really plays a role when we're talking about real estate or any type of like business equipment. The avoidance of depreciation recapture. Oh my gosh, what's depreciation recapture? Should we do another episode on that? We probably should. Here's what depreciation recapture is. If you have an asset, let's use an easy example. Let's say you bought a rental property for $275,000 and there was no land allocation, so exactly $10,000 depreciation every year. Let's say you own that property. You bought it for $275,000. You owned it for 10 years. You took $100,000 of depreciation deduction, right? So you've deducted that on your tax return. When you sell the property, you have to recapture or take that $100,000 of depreciation deduction and put it on your tax return. That's depreciation recapture. So let's say, John, you bought the property for $275,000. You owned it for 30 years. You wrote the entire $275,000 off over your lifetime. You get smacked by a beer truck. John, I know you like some darker beer. So what kind of beer truck would you want to take you out?
Oh man, let's say there's a Guinness rig just rolling through town. If you're gonna, if I'm gonna go out by getting hit by a truck, I mean, maybe it'd be like a Patron truck or something. Try to get real fancy and real, a little bit, whatever.
We'll go with the Guinness truck, John.
And actually, before we jump into this example too, so really quick, one thing we mentioned before is that we mentioned long-term capital gains, and if I'm understanding this still correctly, right, long-term capital gains comes into effect after 1 year of owning an asset. Correct. Short term,
thank you for bringing that up.
Is 0 to 1 year. Correct.
Correct. After 1 year, an asset gets long-term capital gain treatment, which in general is about half of the tax rate that you would pay otherwise. In general, there's a lot of rules with it. Well, the cool thing is, so you bought that property, owned it for 30 years, you depreciated the entire amount, John, you greedy pig, you wrote off all $275,000, you get smacked by a Guinness truck, and your daughter inherits the property. Good for her. Bad that you're gone.
I appreciate that.
Yeah, the property now is worth $500,000. Hey, good job, John. You made a good investment. Guess what? One, your daughter gets a basis of $500,000, and she gets started, if she keeps this as a rental property, she can start depreciating it all over again at $500,000, and she does not owe a penny of depreciation recapture on the $275,000 that you wrote off over your lifetime. So the avoidance of depreciation recapture is the second big benefit. The third is, and this is kind of a dual benefit with the IRS, it's a simplification of tax calculation. Do you know how difficult it would be to figure out what someone's cost basis is if someone passed away and they bought something years and years and years ago? Now, rental property, you usually have a depreciation schedule on your tax return. But John, I mean, real life examples, both of our grandparents back in the day bought stock certificates, right? Bonds, but mostly stock certificates. And a lot of times those stocks certificates, it's hard to determine how much they paid for them. They're just sitting in a safety deposit box somewhere, right? Or think about the example, John, let's say you bought a mutual fund and you owned it for 20 years. And every year that mutual fund paid a little bit of dividends and you just reinvested that dividend back in to the mutual fund. It's very challenging to figure out what your cost basis is. So the simplification of the tax calculation, not having to worry about what the decedent's cost basis was, is the third benefit of a step up in tax basis.
And really everything that we've talked about here, I mean, and to be totally honest, right? Again, this is coming from somebody who, again, in all transparency, didn't know a lot about this before me and you are literally talking about this right now. This really seems like this may be one of the, we'll call it an Easter egg or a surprise or whatever the heck we want to call this thing, where the IRS they could have made this a lot more, or I should say a lot less beneficial to the taxpayer. This is something I think that holds so much weight, and it's almost we should be thanking them in a sense for doing this because they really don't have to in a sense, right? And, oh no, go ahead.
Right, no, I'm sorry, yeah. I'm good at interrupting you, so I'll do it again.
No,
you're right, that the IRS, it is simplification for them and us. Now, spoiler alert, we're going to do some deep dives later this year into the presidential candidates' tax plans. And there are some tax plans out there that want to eliminate the step up in basis, in which there's some, just like many tax laws, a lot of times there's unintended consequences, right? But you're right, it is a simplification. And so it does help the IRS a bit too.
And let me ask you this actually too. So this is, kind of you getting back into your private practice a little bit. So first question, how long has this actually been around for? Is this something that's new? Is this something that's probably been around for a long time? And if, you probably don't even know that because it's probably, it's one of those things. It's just here now. It's important. We focus on it. But more importantly, how many times thinking, again, in your private practice, people that have, say it's come, quote unquote, tax time, or they've inherited something and they don't know this exists. And maybe they, were with a previous accountant before, CPA, has done all their preparing. And you look at it and say, well, what did you do with this, 2, 3, 4 years ago? Can you go back, or did you, or can you, or should you go back and adjust for this? Or is this something that you kind of have to jump on right away? Like if we look at, a 1031 exchange, it's not something that you can, oh crap, I missed the window. I can't go back. How does it look in this case?
Well, this has been around for at least 25 years. I don't know when exactly it started, but or at least as long as I have been practicing. You nailed it. I can't tell you how many times we identify an error on a tax return that's a pro-taxpayer. So I'll give it, and yes, you can amend your return in many cases, or in some cases when it comes down to real estate, you can make an adjustment to your depreciation schedule using what's called a 481A adjustment. I don't want to get too technical. So let's think about practical takeaways for our listeners. The first thing is, when you inherit property, especially stocks, mutual funds, et cetera, don't take the cost basis on the brokerage statements as gospel, because sometimes those brokerage statements have the original cost basis before you inherited the property, and it might report, with a cost basis that's much lower than what the cost basis really is when you inherited a stock. So let's say, John, you inherited a stock that was worth $5,000 when you inherited it. Let's say your parents bought it for $2,000 and you just took over, you transferred that stock into another statement for you, right? You were the beneficiary of their brokerage account. So not all brokerages will adjust the cost basis up to the new owner's cost basis. So you go and sell it and it looks like you made $3,000, but really you didn't. So my point is, if you are listening to this and you have inherited assets, especially in a brokerage account, let's start there. Make sure you talk to your tax professional and your financial advisor to ensure that the proper cost basis is being reported on those statements. And that if you sell it and it's inherited, it's coded as a long-term capital gain. Now, if you own real estate, this is where it gets really, really interesting. If you own real estate that you inherited, make sure that you started your depreciation schedule, meaning when you're going to deduct it, from the day you inherited it. One more huge tidbit. If you live in a community property state, there's a chance that you can get what's called a double step up in basis. So let me walk you through. I said I'm going to have a real life example. Let me walk you through an example, okay? John, let's go back. Let's say that you bought a property. Let's say you and your lovely wife bought this $275,000 property, no land allocation. We want easy math, right? And you get a $10,000 depreciation deduction every year for that property, okay? You guys own it jointly. You get hit by a beer truck. Your wife survives, all right? And you've owned it for 10 years. Well, what would happen is she actually inherits half of the property, and she should step up your half on the tax return and reset your depreciation schedule, which is huge. She's going to get a lot more deductions. She keeps her half of the depreciation schedule on the same. But let's say you live in Texas, a community property state. You get smacked by a herd of cattle or an exotic animal down our Friends of Wildlife Partners, right? You get you're knuckleheading around, you jump a couple of fences and you get trampled. What would trample you over there? I'm trying to remember some of those animals, man.
Pretty much every one of them out of there is bigger and faster than me. So pretty much every one of them I could find a way to, stir the pot.
And you get trampled. And but in Texas, right? Since it's a community property state, there's a good chance that she gets to step up the basis of 100% of the asset, meaning she gets to start fresh and redepreciate that property. And let's say that property that you bought for $270 is worth $500 now. Guess what? You get to start fresh. $500,000, reset your depreciation schedule. So the point is, if you own any type of rental property and you are a widow or you have inherited it, make sure that you, what we call, review your depreciation schedules, or realistically have your tax professional review your depreciation schedules, because you might not know what the heck you're looking at. In the state of Tennessee, and this comes back to estate planning also, so please reach out to our community, jump into our Defeating Taxes private Facebook group. John's going to slap me for mentioning it during the show, but I'm going to do it anyway.
There's a slap.
Ask some questions.
It's all good.
Really focus, because like in the state of Tennessee, we're not a community property state, but we have a special trust here that gives people a double step up in basis, even if they're not a resident here. So there's some really great estate planning opportunities for people as well. So that's why, people think step up in basis, I haven't inherited anything. Well, guess what? If you're a widow, you might have a step up in basis, and you could legally and ethically reduce your tax you paid in your lifetime with no out-of-pocket cash. So at least once a month, John, someone in the teaching tax law community comes to us with, a lot of times they'll come to us with a question. They might be doing, John, I do a lot of one-on-one tax coaching and your personalized tax plans. And sometimes they're asking me questions about something like retirement or stuff like that. And I'm looking at the depreciation schedule. I'm saying, oh my gosh, guys, we have a ton of deductions sitting on the books that you don't know about.
And that's actually a great kind of wrap up on things too, Chris. And to make you feel better, man, being in Michigan still, I don't think we're a community property state, are we?
No, I've been doing some due diligence, and there's some opportunities for people to potentially create a trust in a community property state, even if you don't live in one, and get the double step up in basis. So just reach out to us, jump in our community. And John, can we wrap on one really, I know I use some examples with depreciation and rental properties. Let's use a super easy inheritance situation, okay? To
Absolutely.
wrap on. So let's say you've got Cindy. Cindy inherits a piece of property from her grandmother, right? Grandmother bought, it's just land, so we're not dealing with depreciation. Cindy's grandma bought a plot of land for $50,000 because her grandma was going to build a house on it, but grandma never built the house on it. Grandma passes away, Cindy inherits the land. Now the land's worth $300,000. Cindy could then go sell the land for, let's say, for $300,000. She doesn't pay tax on that $250,000 of gain. And even if Cindy only owned the property for a month, it's still long-term capital gain if she has a gain, or she could have a capital loss if something went down after she inherited it. So
that's a great example. Very cut and dry for the most part. So I think that's one, that we can relate to. And really, Chris, I think what's super important about this show, this topic, is that, what we talked about is not a theoretical thing, right? Like 1 in a million, this might happen to. A lot of people inherit different things, right? So I could see this being super beneficial, say to somebody who's younger. Maybe they just have been DIYing their tax prep every year. That's great. Maybe worked for them. They inherit something. They don't know this exists. The software probably doesn't know this exists. Maybe even their tax professional they're working with doesn't know that this exists. But super important, right? Because this could literally, sure, inheritance is just that. It's great that you're inheriting something, but the likelihood that you're inheriting it because of a bad situation is very high. So make it a little bit better. But definitely, Taco, Chris, what you said there too. Any of those questions, Defeating Taxes is the place. Defeatingtaxes.com. Go to that. Drives you directly to the private Facebook group. We make it short and easy for you. We are very efficient around here. So we make it easy. That's your private invite. If you don't join, well, then, it's on you. Shame on you. And, we're not friends. But in all seriousness, thank you, everybody, for joining us back here. We will see you back here again, as always, same time, same place, next week. Hey everybody, John Trapolsky here, still from the Teaching Tax Flow team. Couldn't get rid of me that easy, even though you probably tried. But I know this topic. Actually, I'm going to say well over half of you probably didn't even know that this exists. And let's be honest, hopefully you don't need to, know this for a little bit. But the important thing about this is exactly what I'm about to tell you. A lot of the things we talk about here on the podcast is really based around tax planning and strategy. If you're not familiar with what that is, go back. We did a couple shows, I think a little bit earlier on, a few months back. We really broke down the difference between the two. And really, on every show we do, I think a very important takeaway from this one as well, specifically, is just understanding that the relationship, let's be honest, the relationship you may have with your parents or your family member or your in-laws, whoever you may be inheriting stuff from, you can control that a little bit, maybe not, but the honest truth is you can actually control the relationship you have with the IRS by tax planning and strategy. So I'll leave it at that. Won't dive into that. Totally different topic, but everything we talk about here does relate to that. Little bits and pieces every week. We like to drip out, bringing in guests. Obviously, Chris is welcome back here anytime, considering that it is his show. But we look forward to all those questions that people in the community and the general public have. We love getting them. We love talking about them, and we love discussing them amongst our team and our guests. So, as always, thank you again for joining us here. We will see you very soon.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.